We also can allocate common fixed costs. So there are arguments for and against common fixed cost. So we have that common fixed costs would not change even if one center were eliminated. They would still exist. Common fixed costs are not under the direct control of the manager, and any allocation of common fixed costs would change the profitability that doesn't relate to the center's actual performance. The next thing that we're going to talk about in this chapter is transfer pricing. So transfer pricing occurs when goods or services are transferred from one department to another. Transfer prices are an important part of departmental performance analysis. So the transfer price is the dollar used in recording the interdepartmental transfer. So we see here that the retail division transfers stuff to the mail order division to be mailed out to the customer. There are three different ways to calculate transfer price: market, negotiated, or cost plus. So transfer prices for profit centers. Profit centers normally sell to organizations outside of the firm. Some profit centers also provide to internally to the business. So when companies do that, they sell both outside and provide internal operations. We generally use market value as the transfer price. This way, the departmental profit is the same whether or not we transfer internally or sell to the outside. Transfer prices when a market price doesn't exist. So we don't always have an outside market for the products that we're transferring internally. When we don't have a market price to use, we can negotiate transfer price or use a cost plus transfer price. And the negotiated transfer price, the supplying and receiving departments negotiate and agree on a transfer price that benefits both divisions. In the cost plus transfer price, we use a predetermined markup to the total cost of the product transferred. Some companies want responsibility managers to transfer products internally, but don't want to use negotiation because it can cause infighting between the managers. By requiring a markup over cost, companies automatically allocate some profit to the supplying division, so it's not just transferred at cost. So we can look at this transfer price impact on division. So we have division A and division B, and we have negotiated and cost plus transfers. These transfers act as revenues for division A, but they're costs for division B. So we can see that division A wants that negotiated price of $53, where division B benefits more from a cost plus price because it gives them higher gross profit and return on sales. There's a lot of controversy around transfer pricing, and it's a very important concept in accounting. So when we have multinational companies, setting appropriate transfer prices is much more complicated, especially if we're dealing with taxes, duties, tariffs, international trade agreements. We're also dealing with foreign currency translations between countries. The market value in countries can be completely different. So when we make intercompany transfer prices, those transfer prices are eliminated when our company-wide financial statements are constructed. So they're not actual revenue for a firm, but they are used for departmental analysis. They are used as revenue for internal documentation just for performance analysis. However, international transfer prices between subsidiaries in two countries with different tax rates can have cash flow implications for the overall firm. So if we have subsidiaries that are operating in multiple countries, we can negotiate transfer pricing to give us tax benefits that then have cash flow benefits for us. So we have this example of Microsoft. So we have transfer pricing practices by international companies, which creates income shifting issues for the IRS. So we have Microsoft Corporation. So they have tax contingencies and other income tax liabilities were 12.1 billion and 10.4 billion. This increase relates primarily to adjustments to prior years' liabilities for intercompany transfer pricing and adjustments. They settled a portion of their IRS audit for tax years during the third quarter. They also continued to be subject to examination by the IRS for multiple tax years. So they're being reviewed for income tax liabilities related to transfer pricing. And we're going to look at the tax impacts of transfer pricing in some of our examples. So transfer prices are only entries made in the accounting records to record the flow of goods and services among departments within the business. So the transfer price can be viewed as revenue earned by the segment supplying the product and as a cost to the segment receiving them. The departmental revenue and cost amounts are equal. Transfer prices have no direct effect on the company's overall pre-tax operating income. We also need to consider non-financial objectives and information when we're looking at departmental performance evaluation. So any non-financial information that we want to look at would be any personal management. Do we have high employee turnover? Do we have employees complaining that they don't like it? We also have any product quality, number of customer returns, number of customer complaints. We would also have any positive reports from customers, our marketing. If we're increasing our sales, we've increased the number of customers, etc. Cycle time, occupancy rates, any efficiency and capacity thing. Non-financial considerations for performance evaluation are very important. They've found in the past that if they focus only on financial performance, that this incentivizes managers to commit fraud in order to make their financial performance appear more impressive. So we look at this ethics, fraud, and corporate governance. So transfer pricing is a tool for corporations to shift profits internationally as a way to avoid taxes. Here we have an example about Apple. So they have allegations against Apple for transfer pricing. They were able to keep a disproportionate amount of profits within Ireland, allowing them to avoid US tax obligations. So we have that over a 4-year report, Apple had allocated $4 billion in research and development costs to its US unit, which had $38.7 billion in profit. Well, its Irish subsidiary had $4.9 billion in R&D costs and $74 billion in profits. So as I said, we will look at some examples in class of how tax transfer pricing can be used for an advantage in taxes. So for responsibility center reporting in financial statements. So large corporations can have thousands of centers and units and regional locations. We have to disclose, FASB requires us to disclose segment information in notes in our financial statements. Usually this happens based by geographical regions in which the company operates. But then we also have companies which own multiple brands will report as a whole And then within their financial statements, their annual notes will also break out into their different brands. For example, Nike will report on Nike as a company as a whole, but then in their financial statements, they will have individual reports for Nike, they'll have individual reports for Converse, and then they'll have individual reports for shoes versus clothing. Okay. Then we have difference between US GAAP and IFRS. So both US GAAP and IFRS require companies to report their operating segment information in their financial statements. And in class, we'll pull up a financial statement and we'll look at how this reporting gets done. IFRS requirements are more extensive than US GAAP. They have to provide a lot more information. US GAAP requires companies to report segment profit or loss within specific revenue and expense items, and they also have to disclose segment assets, but not individual segment liabilities. That is the end of chapter 22.